Let's talk about the difference between Section 179 depreciation versus bonus depreciation. So let's go into the differences between Section 179 and bonus. There's many differences between bonus and Section 179. This is kind of like a fun topic for me. I feel like it's a really complex subject. And most people, most preparers, even experienced preparers, kind of feel like Section 179 and bonus are the same thing. And that's because most preparers only deal with really small businesses, okay? But there are huge differences between Section 179 and bonus, huge differences. Section 179 is always my first choice. It's always my first choice for any business that wants to depreciate an asset. And that's because bonus depreciation is pretty much all or nothing. Bonus depreciation is all or nothing. And bonus depreciation can also create a loss on the tax return, which I never want. I never want to do that. I always want to show a little bit of income. Number one, because the IRS is all hot and trotting over the hobby loss rules, right? If a business shows a loss several years in a row, they can come in and basically reclassify your business as a hobby. You don't want that. Okay, if you can avoid it. The first couple of years, yeah, it's okay. Many businesses have losses the first couple of years, and that's fine. But I always try to avoid having losses. I always try to avoid having losses on the Schedule C, especially if it's the only income. And that's especially true if you have a situation where a person has kids and they might be eligible for EITC. Why would you want to show a loss if the person has kids and can be eligible for EITC? Why would you do that? You do, when it is a self-employed person, you do have to claim the expenses that are legitimate and that they're eligible for. But Section 179 gives you tons of leeway. Section 179, you could claim an exact dollar amount. You can claim sections. Let's say you buy a chair and a computer or a printer. Okay, you can say, okay, I'm going to take Section 179 on the chair, my computer chair or my office chair, but I don't want to take it on the printer. And I don't want to take it on the computer, and I don't want to take it on the power strip, and I don't want to take it on the lamp that I bought for my office and everything else. Remember, an asset is something that has a useful life of more than 1 year. I know that a lot of people, a lot of accountants, will just expense items that are under a certain dollar amount. That's $2,500 or less. You need to know that for part two if you don't know that already. It's $2,500 for small businesses that don't have an applicable financial statement. It's $5,000 for businesses that do have an applicable financial statement or audited financial statements. They get a $5,000 threshold. Most businesses that you're going to see, it's going to be $2,500. But there's nothing forcing you to expense any asset. There's no rule that says you have to expense an asset that's $2,500 or even $500 or even $5. If it's an asset that has a useful life of more than 1 year, you can put it on the balance sheet. Most accountants don't do that because they don't want the extra work. But Section 179 is where you can get creative legally in order to get the dollar amounts right where you want it on the tax return. This is especially true if you have someone come in, they are self-employed, or especially true if they are close to retirement age. You know, I've talked about this in other webinars, like last week. You know, young people, you have someone who's like 20 or 30, they're not thinking about Social Security, right? They don't care. It's too far away, right? You get close to 50, you start thinking about Social Security. You get close to 60 and Social Security is like at the forefront of your mind. Okay, many people, they get to 60, 62, 65, they go down to the Social Security office and they find out that they don't have enough quarters to get Social Security. You don't want to show losses or an NOL on the tax return when someone is trying to earn credits for Social Security. Even just having like a couple of years that show no income on your Social Security statement can be really bad. And you have to have at least 10 years of work, that's 40 quarters, to get Social Security at all. So I can't even tell you how many times I have situations where people were self-employed and they thought they were like getting one over on the government. I have a bonus webinar all about this. If you have a a subscription that allows you to see the bonus webinars. I have one of those in the bonus webinars folder where I talk about this. I can't even tell you how many times I've seen this, where people are like, oh, I'm working self-employed and I'm not reporting my taxes to the government or whatever. And then they get to 62 or 65 and they go down to Social Security office and they find out that they don't qualify for Social Security because they've been working under the table. They've not been reporting whatever else. You need to have earned income at least 40 quarters in order to get Social Security. And many times people don't have that because they're doing like little shenanigans that they shouldn't be doing. But sometimes it'll also happen when you have someone who's running a business and their business is not profitable, or it might be a business where they're not reporting all their income because they're working cash and everything else, and they're trying to like get it to zero every single year. That should never be your goal, never, okay? Especially if a person is eligible for EITC. That's like free money. Okay, why would you throw that away? Okay, so Section 179, you can manipulate Section 179 legally. You don't have to take it on every asset. You don't have to take it on any asset. You could just do a specific dollar amount. You could take it on one asset and not the other. But bonus is not like that. Bonus is all or nothing because you don't get choices with bonus. You have to opt out of bonus in order to not take bonus. Section 179 is an election. You have to opt into Section 179 to take it. You affirmatively take Section 179, but bonus is not like that. For 2022, 100% bonus depreciation amount applies through the end of 2022. We're already in 2023. So this is the last year that 100% bonus exists. Bonus depreciation is 100% through 2022, which is the tax year that you're going to be tested on if you take the exam in this testing cycle through February of 2024. It's going to phase down to 80% in 2023. The Section 179 expense, the maximum deduction amount is $1,080,000. Now, unlike bonus, Section 179 has a phase out, which a lot of people don't understand how the phase out works, but I'm going to give you examples. Bonus does not have a phase out. You could have like a multi-billion-dollar company, Apple, Ford, Tesla, any of these huge multinational companies, they can take bonus on their asset purchases, which is why all of these companies were like, whoo, thrilled when bonus got passed as part of the Tax Cuts and Jobs Act. Because none of these big companies were ever able to take Section 179, because Section 179 is only for small and mid-sized businesses. That was always Congress's intent. Section 179 has a cap. The beginning place in service phase out limitation is $2,700,000. The spending cap is $3,780,000. This is a complete phase out of the 179 election. If you have a business that buys like $4 million worth of equipment in a single year, that's it. They have exceeded the spending cap and they cannot take Section 179. They can take bonus, but they can't take Section 179. The only choices they have, if it's a business that has exceeded this spending cap, is they can take bonus or they can take maker's depreciation, which is like, you know, straight line or double declining balance over the life of the asset. Those are the two choices they've got. Section 179 is out for them. Okay. Now, these are the two differences. And I'm going to tell you, you know, I'm not infallible. I've been doing this a long time, but Congress has been like changing stuff every single year since 2017. It's been really difficult. And on a couple years back, we actually had one of these wrong with regards to bonus. Section 179 can be used or new. Back in the olden days, it used to be that Section 179 was not available for used property, I believe. But now it can be used or new. Bonus depreciation can be used or new. So you buy a used delivery truck, that's fine. Or a new delivery truck, that's also fine. Okay, as long as it's from an unrelated party. The annual limit is 1.08 million in 2022. It's now adjusted for inflation. It didn't used to be. Adjusted for inflation. Every year now it's going to be adjusted for inflation and it's going to go up. This limit is going to go higher. With bonus depreciation, there's no dollar limit, but bonus depreciation is going to phase down and disappear. Assuming, maybe, who knows what Congress is going to do. They've been playing willy-nilly. And I'm going to show you the history of bonus, just so you can see how many times Congress has changed this stupid thing in the last 10 years. Drives me nuts. I wish they would just decide on something and keep it, but they can't. They got to make changes every year. Okay, related party rules. Now, this was the one where I was, 2 years ago, I was not right about this. Okay, Section 179, you cannot take Section 179 on property that's acquired from a related party. Okay, if you buy, like, let's say you have 2 farms. This is the example that I always give because I feel like this is a really realistic example because family farms will change hands and usually be passed down to like a son or a daughter to the child after the original owner of the family farm passes away. Okay. When you have a person, let's say it's a dad and they have a farm with all of this equipment, right? When you have a person that passes away and they pass their, let's say the dad dies and then passes the farm to the son, okay? And then he's going to be running the farm. When you have a person who passes assets to a child, they get the step up in basis on those assets. Let's say the dad had taken Section 179 or bonus on those assets, and the asset had 0 basis. Like he bought a tractor like 2 years ago. Okay, he bought a tractor 2 years ago, and it was like $30,000. And he took Section 179 for that tractor or bonus for that tractor, and he depreciated that tractor down to 0. Okay, it's 0 for the dad. Okay, but then the dad dies. Okay, that death basically restarts the depreciation for the heir. Okay, the dad doesn't own anything anymore. He's a corpse. Okay, that's the hard thing that people just don't understand. When you die, it basically restarts the depreciation for the person who is inheriting the assets. Now, it's not always a good thing because it's the fair market value on the date of death. Okay, and sometimes fair market value can go down. Obviously, that tractor is not going to be worth more than when the dad bought it, but it's going to be worth something. And even if the dad's basis was 0 on the balance sheet, his balance sheet doesn't matter anymore. It's the fair market value on the date of death of the dad. So then you like look it up on Kelly's Blue Book and you see, okay, well, this is the model of the tractor or whatever. I don't know. Can you look up tractors on Kelly Blue Book? Let's just say you can. All right, let's just say you can. So you got that tractor and you look it up on Kelly Blue Book for tractors or whatever it is. And you find that the value, the fair market value on the date of the dad's death is around $15,000. Okay. So then that would become the fair market value of the tractor on the son's balance sheet because the son gets the fair market value on the date of death, whatever that might be. Okay. Depreciation is going to start over for the son. And this is really regardless of what kind of an asset it is. It could be a rental property. It could be a business building. You know, you can't depreciate farmland. You can't depreciate land, but you're going to get either a step up or a step down in basis, depending on what the value of the land is on the date of death. Sometimes it can go down too. You know, property values can change. They can go down, they can go up. But on the balance sheet, the kid who inherits the asset, they get to start with that new depreciation. You set it up in the balance sheet, and you basically have to put, you know, that the value is inherited. It's an inherited value. You cannot take Section 179 on that inherited asset. Okay. And you cannot take bonus on that inherited asset either. But you can take regular depreciation or maker's depreciation. And usually what I do when it's something like that, when it's an inherited asset, or sometimes it's gifted, but most likely it's inherited, you put it on the balance sheet, and then I just take straight line over the life of the asset, whatever the maker's class life is. But you can't take Section 179 or bonus, but you can certainly depreciate it for the son or whoever inherited that asset. You just got to set it up again in their books. Okay. All right. Now, with regards to with regards to Section 179, it can't be acquired from a related party, period. Can't take Section 179 on any asset that's acquired from a related party. With bonus, it cannot be acquired from a related party unless it's new, which was news to me. I just realized this a couple years back. I thought the rules were the same, but Section 179, you can't acquire it from a related party, period. Bonus depreciation, you can take bonus if you acquire something from a related party, but it has to be new property. It cannot be used. So let's say you own like a grocery store and you need a new delivery truck for your grocery store. Your dad owns a car lot, okay, or car lot, whatever they're called. Your dad has used delivery trucks and new delivery trucks. You go in. If you buy a used delivery truck from your dad's car lot, you cannot take bonus depreciation. If you buy a new delivery truck from your dad's car lot, you can't take Section 179, but you can take bonus if it's new. Okay? All right. With the election, with regards to Section 179, you have to elect in. You have to elect in. You have to affirmatively take it. You may elect Section 179 on individual asset purchases. Like you can say, I'm going to take it for the chair, but not for the computer. I'm going to take it for the computer, but I'm not going to take it for the desk. I'm going to take it for the mouse, but I'm not going to take it for the monitor. You could pick and choose. Doesn't matter. Either on all or part of the cost of the asset. You can even say, I'm going to take Section 179 on $100 of this asset. That's allowed. With Section 179, it's allowed. Bonus is the opposite. The election is automatic. You are forced to take it unless you elect out. You have to attach a statement to your tax return. In my software, it's just a checkbox. Okay. And you have to elect out by asset class. You can say that you want to elect out of bonus completely. You can choose to do that. But you can also elect out on a class by class basis. Okay, you could choose to say, okay, I'm going to elect out just on 7-year property. 7-year property is like equipment, furniture, office fixtures, that sort of thing. But you could say, I still want to take bonus on whatever, leasehold improvements. All right, so you're allowed to do that. Or you can elect out completely, which is actually usually what I do. You can elect out completely out of bonus and then just choose Section 179, as long as the business is eligible for it. And then with Section 179, you can kind of pick and choose any asset that you want to take Section 179 on and take straight line on everything else. That's basically what I do. Okay, now, Section 179 is allowable on a delinquent return, and it's never mandatory. Bonus depreciation is not like that. Bonus depreciation is mandatory unless the taxpayer opts out on a timely filed return. Now, bonus depreciation, you can change your mind and file an amended tax return in order to elect out or to elect back in of bonus. But that's only assuming that you filed your tax return on time. If you have a person who is a delinquent filer, they're basically, the choice is made for them. They have no choice but to take bonus. Which means if they bought a bunch of assets that qualify for bonus, they're toast, and they basically have to take bonus on all of those asset purchases, which generally, you know, it can create a loss on the tax return, and then you're dealing with an NOL, which I never like, because Congress is sometimes the NOL in previous years, like we're talking about a delinquent, right? If they're a late filer, then they have to take bonus, and in previous years, you were forced to carry the NOL back. Now you have to carry it forward. But many times when you have a delinquent filer, they'll come in and they haven't filed for like 5 years. And then you got to look it up. Is this the year that I have to carry back the NOL? And then if they're a farmer, then it's like 1 year it's 5-year carry back, and the other year it's 2-year carry back. And the election for the carry back has to be filed on a timely filed return. And it's a mess. It's a mess, I'll tell you that much. So with bonus, it's automatic. They can elect out completely if they want. But if they're delinquent and they haven't filed on time, then that's it. This bonus, they have to take bonus on all their asset purchases, which sucks. You don't get to do any tax planning then. That's it. Okay. Statutory end date. Section 179 is permanent. It was made permanent, and it's now adjusted for inflation. So Section 179 is presumably always going to be around. It was made permanent by Congress. Bonus depreciation phases down to 80% in 2023. So 2022 was the last year that bonus depreciation was available at 100%. From here on out, there's no more 100% bonus. It's going to be 60% in 2024, 40% in 2025, and 20% in 2026. And then in 2027, presumably there's not going to be any bonus. But I'm going to show you what Congress has done over the years with bonus. They've changed it a lot. They've brought it back. They've made it 50%. They've extended it. Who knows what they're going to do? This is how the law is now, but don't go to Vegas and bet on it staying the same. That's all I'm going to say. Well, this is covered in textbook 2, unit 8, by the way. All right. Revocations. With Section 179, revocations are allowable until the statute of limitations on the return has passed. So basically 3 years. You're allowed to revoke any Section 179 election that you've made. You could file an amended return and say, okay, I want to revoke Section 179. I don't want to take these losses anymore. With bonus depreciation, you can elect out of bonus depreciation only if you filed a timely return. Okay. Property cap, we already talked about that. There's no cap with bonus. It's available to all business types, regardless of size or gross receipts. Huge businesses can take it. With Section 179, it has to be tangible personal property, which means like a physical item. You cannot take Section 179 on intangibles, which is a very common question on the EA exam. Intangible would be something like a patent or a trademark or a copyright. So if you bought like a trademark from another company or a copyright from a publishing house or something like that, you can't take Section 179 or bonus on most intangibles. Bonus depreciation does apply with off-the-shelf software, which it is an intangible, right? Software is an intangible. You can't touch it or see it. That actually applies to both. And then bonus, you can take bonus on qualified film, television, and live theatrical productions, which is also a type of intangible. But any other type of intangible, like a patent, copyright, trademark, anything like that, it's not going to qualify for Section 179 or bonus. Qualified improvement property with Section 179 qualifies for roofs, HVAC, fire protection systems like fire alarm systems in big buildings, alarm systems like security systems. Those all qualify for Section 179 on commercial property. So it has to be non-residential. Okay, so if it is residential real estate, it's not going to qualify. But if it is non-residential real estate, like a strip mall or a medical office building or something like that, then you can take Section 179 for these items. And then off-the-shelf software, by the way, means software that the general public can buy. And the price doesn't matter. Like Lacert is like $10,000. So it's really expensive, and it's basically just for tax professionals. You know, like some random guy off the street is not going to do his taxes on Lacert. He's going to buy like TurboTax or whatever. But Lacert is available to the general public for anybody to buy. So it is available for Section 179 and bonus depreciation expensing. Like I said, the dollar amount doesn't matter in that case if it's off the shelf software, regardless of the price. But if you have someone who actually has custom software made for their business, custom software by like, okay, we're hiring a software design firm to create this in-house accounting software for us or this in-house software for our company. Large corporations will do this. And many times companies who develop like mobile games or mobile apps, they will also hire a company in order to develop their own proprietary software. And that software is copyrighted, trademarked, that sort of thing. If you do that, then that is a Section 197 intangible, not Section 179. I'm not saying it wrong. It's not a typo or a mistake. It's not Section 179. It's a section 197 intangible if you have software created for your business. Now, when we were first starting out with PassKey, we actually did contact a software firm. I'm going to give you an example so you understand, to like wrap your head around how much this sort of thing costs. We did contact a mobile app firm in order to develop a mobile app for us. The cost of development of a mobile app that would go into the App Store, like Apple App Store, the starting price was like $50,000. Okay, so that was the starting price to have this company develop a mobile app. And we actually priced it out with several other companies, and they were all about the same, between 30, 50, one quoted 150,000 in order to get that app developed. That is an example of software that is not off the shelf. If your business develops something like that, where you own it, you own the software program, you had it specifically designed for your business, then that is a section 197 intangible. That has to be amortized over 15 years, and it is not eligible for section 179 or bonus. Okay? But if it's off the shelf and anybody can buy it, regardless of the price, then that's eligible for section 179 or bonus. Okay? Understand the difference. And then single purpose agricultural or horticultural structures. This has been on prior exams, so you have to remember this. Single purpose agricultural horticultural structures are attached to the land, and most of the time they're really expensive. Like a grain silo or a greenhouse, like for a farmer, a grain silo can cost like $500,000. And they're permanently attached to the land. They're like attached to the land, but they're just for storing grain. So it's not like a residential building or a business building where people actually go into it. It's attached to the land, but it's not treated as real property. It's a horticultural or agricultural structure, and those are eligible for section 179 or bonus. And like I said, most of the time they're pretty expensive. Okay, now bonus, I just got a couple more minutes and then I'll finish this up. Bonus depreciation qualifies if it's tangible personal property. Once again, most of the time something you can see or touch, like, you know, cars, desks, business equipment, livestock that's held for breeding, draft, or sporting purposes. Sporting means like a thoroughbred racehorse, something like that, with a recovery period of 20 years or less, including machinery and equipment. Qualified film, television, and live theatrical productions also qualify. So like if, you know, you're like Peter Jackson and you're doing Lord of the Rings, you know, then, or whatever, then that's going to qualify for bonus depreciation. I don't have very much experience in that area, but the type of film production that does not qualify is the only type that doesn't qualify is pornographic films. Pornographic films do not qualify, but other types of television, theatrical, or qualified film productions do qualify for bonus. Off-the-shelf computer software, again, trees bearing fruits and nuts like almonds, that sort of thing. Many times a farmer will spend $1 million on this sort of thing if they have orchards. So trees bearing fruits and nuts will qualify for bonus. And then land improvements, this would be something like agricultural fencing, like you put fencing around your property. Let's say you have 150 acres and you put fencing all around your property. Irrigation, like if you have farmland and you're irrigating the soybeans or whatever it is, and walkways, that sort of thing. Okay, those are land improvements. Land improvements are generally 15-year property. You can't depreciate land, but you can depreciate improvements that are on the land. And that's a really common type of depreciable item for a farmer is the land improvement, fencing to keep the cows in and stuff like that. Okay. This slide has my LinkedIn profile contact information. Feel free to connect with me there on LinkedIn. It's just linkedin.com and Christy Pinheiro with a /. I'm pretty easy to find, and you can connect with me there if you'd like.
We've reached the end. Please make sure to subscribe and check out our other educational webinars.